Good morning from London. I'm Guy Johnson. I'm alongside Tom Mackenzie. We are an hour away from the opening trade. What do you need to know this Thursday morning? Well, investors pausing for breath after yesterday's CPI-driven everything rally. We'll bring you the latest on the markets. TSMC's Q4 profits topping estimates as American AI spending drives growth. We'll bring you the latest on that as well. And Israel and Hamas agree a ceasefire deal. It will last 6 weeks. It will see 33 hostages released alongside hundreds of Palestinian prisoners and bring a temporary halt to fighting that has killed thousands, Tom.
So some reprieve on the geopolitical front as we look ahead to Sunday. As you say, the everything rally on equities not just powered by the softness that we saw in CPI out of the US yesterday, with core coming in at just 0.2%, but also the earnings story. TSMC coming in with very strong numbers. That's going to lift the semiconductor space in Europe. Richemont as well with blowout numbers. European futures now pointing to gains of 0.2% after the rally for European stocks yesterday. Here in the UK, the FTSE 100 looking to add 0.3%, despite the fact that GDP has just come in slightly softer than the estimates of just 0.1% growth for November. The 10-year currently yielding 4.64. Yields moved lower by around 15 basis points yesterday on that softer CPI print. And the Japanese yen at 156, gaining on expectations that the BOJ will go with another hike next week. That, of course, on Bloomberg reporting. 156 on the Japanese currency. The countdown to the opening trade starts right now.
Thursday the 16th. Good morning, folks. Wow, what a day yesterday was. We anticipated that 2025 was going to be delivering volatility. We've already seen significant amounts of that. Is it going to continue? CPI was the driver yesterday. We now get GDP data out of the UK, as Tom has already indicated. Comes through a little bit soft, which is interesting and concerning, certainly for Chancellor Rachel Reeves. As Tom pointed out, we come through with a 0.1 read versus a 0.2 read that was anticipated by the markets. We are also watching what is happening in Florida. Blue Origin's new flagship rocket, New Glenn, is sitting on the launch pad. We are 45 seconds away from a launch from the Complex 36 in Florida. This is a huge moment for this company that has delayed and delayed and delayed. And watch what has happened over at SpaceX. Let's listen in to what is happening on the other side of the Atlantic in Florida. A huge moment as we watch the launch of this rocket.
Here we go, New Glenn. It's time to do this. Let's light this candle.
Autopilot enabled. T-minus 10, 9, 8, 7, 6, 5, 4. Lift off. All 7 engines at full thrust. Checking for pressures are good. Vehicles cleared the tower. Now passing 18 seconds into flight. Engine chamber pressures look good. 27 seconds in. Vehicles now begun the pitch roll maneuver to point down range. Body rate responses are nominal. Chamber pressures continue to look good. Now 40 seconds into flight.
Oh my God!
End of roll. Strakes now level. Chamber pressures continue to look good. 50 seconds in. Data quality looks good coming down from the vehicle. Chamber pressures continue to look nominal. 1 minute into flight. All 7 engines continue to look good on the first stage. Data quality is good coming down from the vehicle. Body rate responses are nominal. 1 minute, 15 seconds into flight.
As we build a road to space for the benefit of Earth.
Profile looks good.
7 BE4 engines. You're looking at live pictures of the event taking place somewhere now above Florida as the New Glenn rockets, driven by Jeff Bezos, you could argue, in so many ways, as well as those rockets, finally launches. A huge moment. Tom, the SpaceX have some serious competition.
Well, this is the competition. As you say, about a decade in the making, their engineering approach has been very different. This has a bigger payload than the Falcon rocket of SpaceX, though the Starship, which they're building out right now at SpaceX, will have a heavier payload than even this. But for now, this is a catch-up play from Jeff Bezos, and this is significant. What we're going to be watching for next is how this rocket detaches, and indeed if the main part of the rocket is able to land successfully on this ocean drone, because the reusable component is so essential to Jeff Bezos as it is for Elon Musk at SpaceX as well. So that will be the next part of this journey that we will monitor and bring for you live. But this, of course, is a huge milestone for Bezos and Blue Origin. They have a test satellite as part of that payload, and they'll be getting data back from that as well.
Absolutely. A lot has gone into this, a huge moment for this company as it makes a huge step forward in terms of its ability to launch into low Earth, medium, high Earth orbits, critical endeavours in terms of the process of becoming a serious competitor to SpaceX. We will watch that separation. We will watch that launch and bring it to you as it comes. Let's bring into the conversation now Bloomberg's Bill Ferris. Bill, you've watched this. You've watched the space story develop in the United States. It has been dominated by SpaceX. Did that change a few minutes ago?
Well, it certainly looks like it is. This appears to be, so far, a very successful launch. We're, of course, still going to wait and see if Blue Origin is able to put this kind of test satellite that they're carrying as their payload into orbit, and then whether they can land that first stage after it separates back on that ship floating off the Florida coast in the Atlantic. Blue Origin has tried to temper expectations for that last part. They say their main goal here is to get into orbit, get this test satellite launched. It's going to be up there for 6 to 8 hours. That's their main metric. But if they can pull off a landing of that first stage back on that ship in the Florida Ocean, that will be a huge validation of years, more than a decade of work that's gone into this rocket, and that has been delayed since 2020. That was the original target date that Blue Origin had for this launch. So for almost 5 years delayed at this point, but appears to be successful. At this time in the launch, the rocket would have already passed the moment of maximum stress and should be separating really any second now if it hasn't done so already.
Yeah, well, Bill, in fact, we have a line crossing right now. The Blue Origin booster has successfully separated from the upper rocket. You talk about the fact that this is a secondary benefit if they manage to land this on the drone ship successfully, but reusing these rockets is essential in terms of the commercial viability of Blue Origin and you, Glenn. Bill, you've been watching launches. You've been watching launches in Cape Canaveral since you were a child, so you have some historical context to this as well. Talk to us about how you frame this moment then, given your experience, but also what the commercial endeavours will be for Bezos and co. going forward.
Yeah, it's a super exciting moment. As you mentioned, I grew up there on Florida's Space Coast, just a little more than 10 miles south of that Canaveral launch station. So even when I was in school, they would take us outside to watch launches during the day. And then everybody at this kind of a launch at night there in Florida, the beaches would be packed. Everyone would go out to the coast and watch. Back then, of course, I don't want to date myself, but launches were a lot less frequent. Sometimes you went a couple months between launches. They've now become a monthly thing, sometimes multiple times a week. And at times, as the space industry became privatized, it's a huge deal for the space industry, frankly. As you mentioned, SpaceX has had a real lock on the competition. This potentially puts Jeff Bezos and Blue Origin into that conversation. They have a $10 billion backload of payloads ready to go if they can keep up this kind of a pace now.
Bill, as you say, this is becoming almost a daily, weekly event that we are watching. Many rockets are being launched, and it does seem as if many of them go without a hitch. How many times does Blue Origin need to launch this rocket before you can really say it stands side by side with SpaceX and the ability, the guarantee that almost comes with the rocket launches that Elon Musk's company now delivers?
Yeah, they do. They will have to show more consistency. This is actually this is for Blue Origin. It's considered a national security test launch. They need I think 3 more of these to get a certification from the Pentagon to do more classified Defense Department oriented payloads. They need to just show more of a consistency, and I think a big test of that will be whether this first stage is able to land. That would be kind of an unexpected success in a lot of ways. Typically, first launches do not go exactly as planned. So if they can pull off the launch, the deployment of their test satellite, and the return of the first stage, it would be a huge bonus, very exciting moment for both the space industry and, of course, for Bezos and Blue Origin. But if Blue Origin can pull all this off and have some more successful launches, it will bring real competition to this nascent private space industry that's growing and accelerating, as you just said, year by year.
What are the triggers? What are the kind of drivers of the demand, Bill, for access to space at this point? Is it simply getting satellites into space? What are the businesses? Which businesses? What are the commercial interests in orbit and near orbit?
Well, getting satellites into space is a big part of that. I mean, I think about half of the satellites in space now are owned and operated by Elon Musk and SpaceX. That's, of course, the Starlink system. Jeff Bezos has his plans for a Starlink competitor, so that could drive down costs in terms of satellite communication across the world. But Bezos, just like SpaceX, Blue Origin has plans to help NASA get landers to the moon, and then beyond that, of course, there is this competition to get development on Mars, get humans to Mars. That's something, of course, that Elon Musk has as like a driving goal of his life at this point. But this just brings a lot more competition. It should drive down costs. So you're talking about countries that perhaps have not been able to afford getting their own satellites into space, having that opportunity. It will allow for a lot more scientific tests to go on, and it will allow for greater options in terms of communication.
Bill, how far ahead is America? How far ahead is Jeff Bezos, Elon Musk? I had lunch yesterday with the CEO of Airbus, talking a lot about the opportunity of space in Europe and how Europe needs to consolidate to drive forward, to deliver the kinds of systems that we're seeing operating now in America. How far ahead is the United States?
Well, the U.S. in particular, Elon Musk and SpaceX are quite a ways ahead. I mean, we'll see how this launch goes, but Musk is the only one who's been able to build this system of reusable rockets. And that is the real big factor in terms of driving down costs. Blue Origin hopes to use this first stage that we've just seen launch right now. They'd like to reuse that 25 times. If you can't do that, it's very hard to have a financially sustainable system to get into space. No one else has done that. China, of course, is always a factor when you have these discussions. They had a kind of a difficult 2024 when it comes to their space industry. They did not get the number of launches they wanted, and they just haven't had the kind of success that you've seen coming from SpaceX. So at this point, the U.S. has a good lead. It's one of those things, though, in a highly technical field and in a highly expensive field that could change very quickly if China starts showing more success. India is, of course, ramping up its efforts as well. But right now, SpaceX is the most reusable, most reliable partner when it comes to getting into space. Blue Origin wants to take a crack at that now.
Yeah, and look, frankly, China and India are playing catch up, right? This is just another reminder of the innovation and, frankly, the vision as well that is coming out of the US in areas like space technology, and the gap is clearly there, even if some competitors are looking to close that. Bill, what do we know about the regulatory environment? We know that Elon Musk he's talked about his frustration in terms of regulators slowing down progress around SpaceX. Is that something that's likely to change under a Trump administration? And where is SpaceX on that Starship progress? Because that will have a bigger payload even than New Glenn, which is what we're watching right now.
Right. Yeah, SpaceX, listen, Elon Musk and SpaceX and Tesla, frankly, all the Elon Musk companies have always had this ethos of move fast and break things. And it's kind of interesting because Blue Origin has had a little bit of the opposite approach culturally as a company. They have taken a lot more time trying to get set up for these launches. SpaceX has been willing to say, listen, we're testing the engine, and if the rocket makes it to space, that's great. If it blows up, we'll learn from that too. I think the big question going forward is just the pace of development. SpaceX, Elon Musk is, of course, very close to Donald Trump. He's got one of his key aides at SpaceX who's going to possibly be the next administrator of NASA. I think the regulations around the development of the industry are going to be a big focus for the next administration, particularly with Musk right there next to Donald Trump. Yeah. So the goal is to try to accelerate those developments and get speed up this industry so you get even more launches on a quicker pace.
Bill, we're potentially about to watch the landing of the booster phase. Just in terms of the complexity of what we're looking at here, is it harder to come down than go up? Is it harder to land this thing than actually launch the rocket in the first place?
Yeah, I think you probably want to talk to a space engineer for that. I mean, I will say, I grew up on the Space Coast, grew up watching launches. The very first time, maybe about 10 years ago, that I saw a SpaceX booster come down after going up was something unlike anything I had ever imagined I would see in my lifetime. It's a highly technical thing. I think a lot of engineers from previous generations would have said it was an impossible task to achieve. So the idea that you have that happening regularly, and as we saw just, I think, in November, December with one of those SpaceX launches where the control tower actually captured the booster, the technology and the abilities of what the engineers can think about has changed rapidly. And that's really what's going to help drive costs down and help drive the industry forward.
We are seeing live pictures right now of the Blue Origin team on the ground, of course, cheering and celebrating as they meet that first objective of this mission. We can listen in. They've hit that first objective, which is to get into orbit safely. Talking about how happy they are, of course. Yes, this is a major achievement. It's a major achievement, of course, for Blue Origin. It's a major achievement for Jeff Bezos. The second objective, of course, as we've been discussing, is to land the main booster on that drone ship then, the Jacqueline drone ship in the Atlantic Ocean.
They had to delay the launch a little bit, which is why it started at the beginning of this programme, because there was a boat that drifted into the area in which they were going to be potentially landing, or hopefully landing, the booster stage. So that was why
a fisherman somewhere getting in the way.
Precisely. That's why ultimately this thing got delayed. So at the moment, Blue Origin is saying it is unclear as to the status of the booster landing, an indication just how complex this process is. Getting up is one thing, coming down a completely different thing as well. But Blue Origin celebrating the fact that they have delivered the #1 priority of this mission, which was to get into orbit safely. That moment has been achieved. We'll see what may happen now with the booster. A suggestion now, a quote from the company, we may have lost the booster. So maybe they've ticked the box in terms of delivery into orbit. The second objective here, to bring back the booster, to reuse it again, maybe that is proving a little bit more challenging this time round. Bill, we're going to leave it there. Thank you very much indeed for your commentary and your insight. Bill Farrow is joining us on the launch. We will continue to monitor the situation as we see it coming in. The quote, as I say, we may have lost the booster, but we've delivered the payload into orbit. We're going to get back to markets next. We're going to go back to the news flow elsewhere. Coming up, Rio Tinto's iron ore shipments take a hit as lackluster demand continues from China. We're going to check in on the miners' shares ahead of the open here in Europe. Plus, it looks like Richemont shares are going to be opening sharply higher. This after the luxury brand reported a big sales beat. Up next as well, we'll focus back on the inflation narrative. We've seen, obviously, the first move down in 6 months. Big move yesterday. The everything rally was on yesterday. We said we were going to deliver volatility this year. That has already happened. And we'll maybe dig into the details of what can happen next off the back of that. You got any questions? You want to join the conversation? IB Plus BBTV Go is the function. This is Bloomberg.
the trend continues to be improvement in inflation. I'm still optimistic for 2025 that we can continue growing and have a soft landing.
Austin, just tilt the camera a little bit lower and maybe we'll be able to see everything. Austin Goolsbee poking his nose above the lower there. Of course, the Chicago Fed president, speaking after the December reading of U.S. inflation, was released yesterday. It rose less than expected. That marks the first step down in 6 months. Big rally, obviously, we saw in U.S. Treasuries, and that rippled around the world. The market's still only pricing, though, 2 Fed rate cuts this year. Is that still too optimistic? Are we going to see more? Marie-Anne Allier, fixed income fund manager at Carmignac, joining us to discuss. Good morning. What do you think?
Good
2,
morning.
is that about right for the Fed when we think about what we saw yesterday in terms of the inflation data?
Well, we saw a good inflation data, and I saw, Goolsbee saying that this inflation trend in here, it's true, but we are still running quite hot. When you look at the core CPI, it's still around 3, so well above the Fed target, even though, the core PC, the next print could be into the Fed target. We are still not at target for the Fed. And especially you have some food prices pressure that are coming into the market. So it's difficult to say that job is totally done, and pricing 1 or 2 cuts may be the right thing. On top of that, you are all of the Trump trades and the tariff and all these things that could derail a bit what we think about inflation.
Marie-Anne, good morning. It's Tom here alongside Guy. What does that mean for your view on US Treasuries there, and how much exposure, where along the curve you might want to be adding, if at all?
I think that probably the short part of the curve is well protected. We are absolutely not, on the camp of those we last Friday was saying that maybe the Fed could hike in 2026 or something like that. So we still think that the short part of the curve is a buy. For the long part of the curve, let's say the 10 to 30 years, it's still a bit more difficult because inflation is still there. You still have a lot of uncertainties. The U.S. economy is running quite hot. You can't say that, we are at the potential growth for now. And that deficit will be high. So, it's still not for us a screaming buy or even a buy, the 10 or 30 years. And we prefer to concentrate on the short part of the curve. Steepening is still the name of the game, I think.
Marie-Anne, stay with us. We need to talk about what is happening here in Europe as well. We've seen the GDP data out of the UK this morning. We need to focus firmly on what is happening there. We saw a big move in gilts yesterday. Is that the right trade as well? Plus, we're also focusing in on what is happening with the French trade. The OAT is so fascinating at the moment, given the political instability. Anyway, we will carry on that conversation in just a moment. It's interesting, Kevin Walsh has written an op-ed in the Journal this morning talking about the fact that actually the market is misunderstanding Trump. The Fed is misunderstanding Trump, talking about the idea that things like deregulation will actually be deflationary, and that will compensate maybe for some inflationary impulse coming through from tariffs.
Well, that is the argument coming through from his Treasury pick as well, who'll be giving evidence later today. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. So we are 30 minutes from the start of the opening trade. It looks like it's going to be very positive in terms of the equities picture. Futures pointing to further upside after a very strong session for European stocks yesterday on the back of that more benign inflation print. Up 0.6% flagged on the European stocks 50 futures. Over in France, the CAC 40 is looking to gain 1%. Luxury will be a factor there, with the gains coming through from Richemont. Over in Switzerland, of course, S&P futures, after rallying 1.8% yesterday, looking to add another 0.3% so far in the session. The bond markets, of course, rallied as well, with yields down, price up yesterday. We saw that pronounced in the UK with gilts And we saw that, of course, in Treasuries as well. The US 10-year falling around 15 basis points in terms of the yield. Currently, the 10-year is relatively stable in terms of Treasuries right now. Here's a picture, of course, on sovereign debt of Europe, largely unchanged, given the moves that we saw yesterday. 256 on the benchmark Bund over in Germany. France, of course, remains in focus, given the political tensions, even if they've eased to some extent, remain focused. 3.3 on the 10-year. Let's get back to Marianne Allier, fixed income fund manager at Carmignac right now. Before we get to France, Marianne, a view on the UK then, and some reprieve, it seems, in the last 48 hours or so for the UK Chancellor Rachel Reeves, with some money moving into gilts and the yields coming off. Do you think we're done for now? Have kind of the yield story in the UK, is it kind of capped out? Do you want to be buying gilts?
Not yet, no. I think the UK had still the same problem that it has, during the past years. It's still a twin deficit economy at the times where liquidity in the world globally is decreasing a lot. Central banks are not adding liquidity, they are taking back liquidity. And when you are a government and you need money, you have to offer more yield. And the US is exporting higher yield everywhere. And you say, yes, the UK has a great rally yesterday, but looking back to where, for example, the 2 years were in August, so 6 months ago, we are still almost 90 basis points above what we were 6 months ago. So I don't think that, again, on the long part of the gilt market, it's time to increase the position and to be positioning.
Let's just talk about where the Bank of England may go from here. It's interesting, Alan Taylor, who has just joined as an external member of the MPC at the Bank of England, suggesting that, 4 is probably the base case when it comes to cuts that should be delivered by the bank this year. He has become increasingly dovish. Certainly that was the indication in terms of his last vote. But he's talking about the possibility of maybe 5 or 6 being needed, 5 or 6 cuts this year being needed to put the UK economy back on an even keel and deliver growth. Is the risk that the bank has to do more at this point, like significantly more than the market is pricing? The market's got 2 cuts in for this year. It's a huge jump to 6.
Yeah, the question is, what do you look? Do you look at inflation or do you look at growth? For growth, maybe, I don't know, maybe 4, maybe 5, maybe 3. Yes, maybe more is needed for growth. For inflation, the question is a bit different because if you cut too much, even now, inflation is not at the Bank of England target. Yes, it's decreasing, but the last print, for example, yesterday, it was due to erratic items. It was hotel, airfares, package holidays. So it's not, maybe we'll have a bit of payback in February. So it's not, again, inflation is not at target. So speaking about 6 cuts may be good for growth, but you will have a huge steepening of the curve. So people on the 10-year will ask for more yield, higher yield, and so you risk a big bear steepening of the curve, I think.
Okay,
and
so 6 seems too much for the BOE. Yeah, I just want to get your views on France, Marianne. Yeah, no, continue, please.
No, it's not a fair question asking a French people or friends. We are still bearish and not very comfortable. We were talking about, UK. France is worse than UK. The only thing is that we are belonging to a Eurozone that had a positive current account, so it makes the big difference versus the UK. But the situation of France is absolutely not fixed. We may have a government still at the end of the day, but we may, the government can fall on the next budget in 1 month, 2 months, and we have a huge deficit to finance. And so the situation is absolutely not fixed, but we are part of the Eurozone.
Yeah, so, well, clearly, and the ECB is still expected to cut, about 90 basis points this year. What are you is there a calendar event that you look for in France that makes you think this could be the moment when French debt becomes attractive again?
I think I believe that it will be attractive again once we have a strong government that will be able to choose one way or the other. You know, we have to tackle the deficit. It could be by increasing taxes. It could be by cutting spending. We need to know what will be, the path of the next government or the government that will be able to do something. The government we currently have absolutely no power to do anything that will tackle the deficit. We know that. He will do the most he can't do. He will do nothing, pretending that he's doing a lot but doing nothing, because he has no power, no legitimacy, no majority at the National Assembly. So to be positive or strongly negative, strongly positive, we need to have a government and to know what will be the future of the path of the reduction of deficit.
Marianne, is the base case that we see parliamentary elections, assembly elections this summer again, and that produces a clear outcome one way or the other?
That's the hope, to be honest. The hope is that we have, as soon as possible, a new election with a clear majority. But again, it's not something that is 100% sure, because even if you have an election, you may end up with a split parliament, and we have in France absolutely no idea of how to work together and make coalition. We are not Italy, we are not Germany, and coalition is something that the way working together is not something that we are used to. So even if we have election in July, it's not, 100% sure that then we will have a strong government with a strong majority.
Yeah.
Especially
and even if you do get a strong... Yeah. Finish the thought?
No, I was saying especially as we are talking about proportional for next election. So if we have a majority scrutiny, if you put some proportional in that, I don't know how it can end up. I didn't see any polls for the moment.
Yeah, it'd be interesting to know if the markets kind of get what it wishes for, i.e. a solid government, but if that government was led by Marine Le Pen, how would that go down as well? It's going to be interesting to see exactly, as you say, how the polls settle out. Marianne Allier, fixed income fund manager at Carmignac, thank you very much indeed. Let's go from the economics to the politics to the geopolitics. The big news overnight, of course, has been what has been happening in Israel and Gaza. There have been celebrations in Gaza and Israel. This after we have seen an agreement of a ceasefire to end 15 months of war. The deal is split into 3 phases. The first beginning on Sunday. Fighting will be paused for 6 weeks. Dozens of hostages will be released, I think 33. Israel will withdraw from the populated areas of Gaza. The US President Joe Biden says the aim is to end the war for good.
During the next 6 weeks, Israel will negotiate the necessary arrangements to get phase 2, which is a permanent end of the war. Let me say it again, a permanent end of the war. There are a number of details to negotiate to move from phase 1 to phase 2, but the plan says if negotiations take longer than 6 weeks, the ceasefire will continue.
President Biden, let's talk about what happens next. He was laying out phase 2, phase 3, the ultimate end to the conflict. Bloomberg Horizons anchor Jumana Basetchi joining us now. Jumana, talk to us about how fragile phase 1 is likely to be and how easy it or difficult it potentially will be to get from phase 1 to phase 2.
I think that is the major question, Guy. And of course, it is a major milestone for the region today. After several attempts to get through a ceasefire deal over the course of the summer, many of them false starts, but the ceasefire deal is here. But as you say, it is a ceasefire deal only as it pertains to phase 1 of this multi-phase deal. Phase 1 is the humanitarian part of the ceasefire deal, in which 33 Israeli hostages will be released in exchange for Palestinian prisoners. Those 33 hostages, out of them, some are reportedly dead or have died in captivity, but there will mainly be the elderly, women and children that are released in this first phase. In addition to that, the first phase will allow for the passageway of humanitarian aid. It is, of course, much needed in the Gaza enclave. 9 out of 10 people in the population are thought to be in a state of acute food poverty. And then the final element to phase 1 is for Israeli forces to gradually retreat away from the central parts or populated parts of the Gaza Strip towards a buffer zone. And then this is the part where it gets perhaps a little bit more challenging, because phase 1 is only a temporary ceasefire. Phase 2, which is the comments that President Biden was just talking about right now, would entail a more permanent ceasefire and a full withdrawal of IDF troops. Now, the Israeli side have said, and always been consistent on this point, that they will not be happy to fully retreat from the Gaza enclave unless they are sure that Hamas are not going to maintain a presence there. And to that effect, that goal has not been actually accomplished. And so it remains to be seen how the transition from phase 1 to phase 2 is going to take place. But one of the elements of the deal is that by day 16 of the ceasefire, which goes into effect on Sunday, they will have to start those discussions about entering into phase 2 and the release of the remaining hostages. About 50 more hostages will still be remaining in captivity. So yes, a step in the right direction. It ends the imminent bloodshed, but still a lot of questions remain about whether this can actually transition to a permanent cessation of hostilities.
We saw in the soundbite there of President Biden, U.S. Secretary of State Antony Blinken standing behind him, behind one of behind his left shoulder. And this is clearly someone who's worked very hard. He's been in the region multiple times to try and get some kind of deal. But was it ultimately actually incoming President Trump who made this happen?
Well, President-elect Trump was quick to take the credit for it with some of the posts that he put up yesterday on social media. But the reality is that, yes, the incoming Trump administration did make a very big last-ditch effort to get this deal across the line. And you may recall back in December, President-elect Trump actually did say that all hell will break loose. This is direct quote. If there isn't a hostage deal before he steps into office. And of course, his inauguration is taking place on Monday. What we do know is that both sides, so Biden administration, Secretary of State Antony Blinken, Jake Sullivan, all of them were in the region over the last couple of weeks to try to get all sides to agree. But then also Steve Witkoff, who is the new Middle East envoy under the Trump administration, he also paid a visit. He met with Doha, with the Qatari negotiators. He also met with the Israeli Prime Minister Benjamin Netanyahu on the Sabbath day. And reports suggest that he passed on a very strongly worded message from President-elect Trump saying that they have no choice but to agree to a deal before Trump steps into office. Otherwise, it could ultimately lead to some damage between that U.S. and Israeli relationship. And so there is a feeling that it is and partially on back of the Trump administration's efforts to get this deal across the line that encouraged both sides to agree to it, and which is why we are in this situation today. But more long-term, the fact that Trump himself is taking ownership of the deal is probably a good thing, because it means that the deal will have the support of the U.S. administration in the coming months as we talk about the thorny topics of moving away from phase 1 to phase 2 and ultimately phase 3, which is the reconstruction of Gaza.
OK, Bloomberg's Jemima Pasecci, thank you very much indeed. Our Middle East anchor, of course, joining us with the latest on that deal with phase 1, as she was saying, kicking in on Sunday. That is the hope. That is the aspiration. Coming up, we will switch focus, because we will focus on the earnings story and what could be moving in the session today. Some of the individual stocks on the move, likely including Richemont, after reporting a surprise jump in sales. Consumers splurging on the company's Cartier products. More on that and your other stocks to watch at the open. That's next. This is Bloomberg.
Overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now.
We're not going back to 0% kinds of normal rates, but rather those low single digits. Is it 2% or 3.5%? It's someplace in there, and we're moving into that range.
If you look over the last 3-4 months, we're basically running at around 2.5%. Which is where the Fed thinks we'll be at the end of this year for the core PCE. So by the Fed's own admission, inflation is stuck around 2.5%. And then also on top of that, the labor market seems to have stabilized. And that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
Some of the guests we've been talking to weighing in on yesterday's important, it seems, US CPI print, and by extension, what it means for Fed policy. Joining us now to discuss the market reaction to all of this is Paul Dobson, Bloomberg's executive editor for Asia markets. Paul, a big reaction to a relatively small change in US data.
Yeah, good morning, Guy. That's right. And if you look at the rounding for the number, it could easily have flipped back into exactly in line with the analyst estimates. So not a very large shift there. I think it tells you on a short-term basis, maybe the market had moved too far too fast. Yet also, there is plenty of reason to still be a little bit concerned about the bond market in particular, right? Because we do know that the Fed is going to be on pause for some period of time. We do know that the US economy is already looking strong. We do know that inflation isn't coming down all that fast. And we do know that we're about to get a new administration, which is going to be announcing some new policies that, all things being equal, may increase supply of treasuries into the market, may push on inflation as well, and growth, and be another reason for the Fed not to be that swift in cutting interest rates any further. I think on the flip side of that, should you be worried about the treasury market? Big question. Seems like not so much, right? We've spoken to investors all around the world, from Australia to Japan, from Europe's biggest money managers. The message we hear from all of those is, yes, okay, maybe the yields are going to be higher temporarily, but we have faith in the US, we have faith in the treasury market, and we're there for the long term still.
So, Paul, if you package that all together, does that mean a major roadblock to higher equities, given the wobble that we saw at the start of the year, has now been removed?
Yeah, I feel like, there's a lot of risk still out in front of us, but the market has regained a little bit of positivity when it comes to equities. As long as the bond market can stay in check, if we do get those stimulative policies coming through now from the new US administration, which we'll learn about next week, then yes, that could give the market a new lease of life again, particularly, people coming back into the tech space, looking favorably there again.
In terms of your sense of how short-term, though, the moves that we saw yesterday are going to be, there's an awful lot coming up over the next few days, including, obviously, the inauguration of Donald Trump. What is your perception? What is the perception of the people you're talking to? Just how choppy trade is going to be? Yesterday, hugely volatile. Does that continue?
Yeah, I think that it's hard not to believe that that's the case. And if you're sitting where we are in Asia, Guy, we get the crest of the wave there because a lot of the announcements that we've been seeing via social media have been coming through right at the start of our day, when market liquidity isn't good to start with. So there are, we've seen it all before. We've been here before with the last Trump administration. We know that there's going to be flips backwards and forwards, and maybe momentum isn't going to be so easy to trade as it was last year as a result. But we also have a pretty good idea about some of the longer term impacts, including stronger dollar, pressure on treasuries, and presumably still favour for the equities market too.
OK, Paul Dobson sitting at the crest of the wave for us. Bloomberg's executive editor for Asia markets. Thank you. And what could be playing into these markets going forward as we look at futures pointing solidly higher in the session today on a granular basis? Let's bring in Joe Easton from our equities team on some of the stocks that could be on the move. Joe.
Morning, Tom. So we got a really positive report out of Richemont today over in Switzerland. The Cartier watchmaker smashing expectations for its sales in the latest period. Now, bear in mind, this is one of the better performing stocks in the sector, given the high end of the market has really outperformed amid a bit of a downturn in that sector. But we'll wait to see if there's a read-through in the peers that have seen big declines over the past year, including we're going to look at LVMH, Kering, Burberry and Swatch in terms of the watch read across as well. Kering does have some extra news today on some property sales over in Paris, so we're going to see if that has an impact as well. Then in terms of chips, Taiwan Semiconductor again really strong in the semi space. That stock jumping over in Asia this morning. We're up around 4% on Taiwan Semi. And the big thing in terms of the peers here in Europe is the CapEx spending. They're spending more than $40 billion on CapEx. That's what they're projecting over the next period, according to their statement as well. So we're going to see if that feeds through into some of their suppliers in terms of ASML, maybe even BE Semi, Siltronic, Soitec as well. Potentially this is going to be a positive read for that sector today. Then Universal Music in its battle with the hedge funder Bill Ackman. Universal says it's going to be looking at a US share sale. This is something that Ackman said they needed to do in order to unlock value in the streaming giant. We did see a massive drop in that stock earlier in the summer last year, so keep an eye on that one. These are the ratings. A couple of decent sells on that screen there. Nokia is a sell over at Goldman Sachs. That could be weaker. AB Foods, the owner of Primark, is also a sell. That's at Citi. And finally, Randstad, double upgraded to buy, potentially going to rise in the staffing stocks today.
Joe, thank you very much indeed. Joe running us through the single stock stories that we're going to be watching. Today is kind of the reaction to yesterday in so many ways. It's going to be interesting to see whether or not the equity trade that we watched yesterday developed so fast and furiously will continue into today's session. Indications at the moment positive. We'll see in a moment. This is Bloomberg. It's Thursday. It's only Thursday. It has been quite the week thus far. We said at the beginning of the week that it was going to be quite a bumpy week. It has certainly proved to be just that. Yesterday was a fascinating session. Small change in the US data. You could argue the same thing here in the UK in terms of the inflation picture, generating a huge response in terms of asset values. The equity markets surging on both sides of the Atlantic. You can see the moment quite clearly on the white line here, European equities, where we see that big lift up post-CPI in the United States. The US market fades a little bit, but then rallies into the close, and that is what we've got to price in first thing this morning. Let's take a quick look at what futures are signalling. A continuation of yesterday's trade. Risk on certainly seems to be the narrative at the moment. Stocks 50 up by 0.8, FTSE up by 0.3, CAC futures up by 1.14%. So we see a continuation of the rally that we're going to be seeing in European equities. We'll watch the gilt market open as well in just a moment. Disappointing data in terms of the monthly GDP print being revealed this morning, slightly below market expectations. A pickup, at least we're getting growth, so we'll see how that gets priced in, maybe to the market story there as well. So that's the picture, a continuation of the rally, but there's some single stocks, Tom, that are really worth watching this morning.
The earnings story looks like it's going to be a catalyst for these markets today as well. You look at Richemont, you look at the luxury space. Richemont coming out with some very strong numbers indeed, particularly the spend on the jewellery part of the business. Asia was a little less soft than had been expected. It was Americas, the Europe as well, spending heavily on Cartier. So we look at the broader lift around luxury and the read across there. Chips, TSMC coming out with profits up, 57% in terms of profits, and the spending CapEx up to $42 billion US dollars. Universal Music Group looking potentially for a share sale in the US as well. So we're watching Universal Music Group, the at the open guy.
Yep, time for the opening trade. Let's take a look at the numbers. I would imagine that we're going to see a big boost coming out of the luxury space into the CAC Caron today, so look for that market maybe to outperform, as we've already suggested. You've got Rio to factor into the FTSE 100. Sterling also something you need to be thinking about as well, as to how you kind of relate the inflation, GDP, to the gilt story, to the sterling story. All of that obviously relevant for the FTSE 100, which is now up by 0.4%. Continue to watch what is happening in oil as well. That's a relevant market to the FTSE 100. So the FTSE's up by around 0.6%. We're expecting significantly more out of the CAC Caron. The Richemont numbers providing another nice little boost for this sector. You've already seen a number of other smaller brands out over the last few days delivering quite nice numbers, and I wonder whether that is going to be this today just gives an added momentum to that story, despite the maybe more bleak macro top-down picture that we are watching. So the IBEX up by 0.6%. The overall market up by around 0.6%. of 1%. We don't have a price yet for the CAC 40, but Tom's going to talk about some of the individual sectors and names, and I suspect while we're doing that, we'll see that market open up and we'll get a better idea of what is happening in luxury, Tom.
Well, technology for now is ripping. Luxury will get a lift as well. Technology up more than 2% as a sector. That, again, the read across from TSMC, a reminder that the spend around CapEx, they are bullish. The outlook in terms of CapEx up to $42 billion. That suggests they see their clients, they see the demand around churning out more of those AI chips will be sustained through this year. The profits for TSMC were up 57%. So we're getting a big lift for technology. Consumer with the luxury piece in that is gaining as well. On the breakdown on the CAC 40, Hermès up 5.2% right now. L'Oréal following closely behind with gains of 3% in the luxury space. Autos also up, interestingly, by 0.9%. Renault came out with some sales numbers at about 6 a.m. UK time. That stock has actually gained in the last 12 months, up about 40% or so. On the downside, telecoms, media and utilities, Guy.
We still don't have a price for the CAC. Let's just see what hasn't opened yet. There's a couple of unchanged stocks. It's LVMH and Kering, both yet to get a price. So two heavyweight stocks we've yet to see trade this morning on the CAC 40 as we see a little bit of price discovery coming through. You are, though, seeing broadly the luxury space having a very good morning. Hermès is already up. It's trading 5.25% to the good. But the two real heavyweights out of that market, no price yet. The market is trying to figure out how to fold the Richemont story into that narrative. Oil stocks continue to gain as well. Total is trading quite nicely. So you're seeing certainly some feed through coming through on the positive side there. There are some downside stocks. It's interesting. We are watching maybe the more defensive end of the market, maybe just soften up a little bit. Stocks like Danone certainly under a little bit of pressure. But we'll wait for LVMH and Kering both to price. LVMH is usually fairly quick out of the gate. Obviously, there's some fairly decent moves that are likely in just a moment when those stocks finally open. Yeah, really interesting that it was softer as expected in China, but less bad than had been expected for Richemont. So is the China story starting to turn around? On technology, ASML is getting a big boost. Of course, you cannot operate a TSMC foundry without ASML's lithography machines. That company, of course, listed in the Netherlands, is currently up 3.5%. So despite all the geopolitics and the additional restrictions we've seen put in place, the maker of those lithography machines getting a lift on the back of TSMC's outlook around CapEx, Guy. Let's talk a little bit about what is happening with the DAX and figure out what is going on there. We do have a DAX that is open, up by around 0.5%. It's interesting, it is that tech story. So you've got names like Infineon doing very well. But defence is also on the front foot this morning, which is interesting as well, given what we see in Gaza. It's less relevant, obviously, to maybe some of the European names, but names like Rheinmetall are up today, up by around 1.4%.
Let's get some more market analysis there and bring in Shaniel Ramjee, co-head of multi-asset strategy at Pictet Asset Management. Shaniel, thanks for joining us. Do you lean into this rally that we're seeing across equities this morning?
Yeah, we think positioning is still quite low. You know, everyone came into the year a bit nervous about what's going to happen. And we saw that reflected firstly in the bond markets this year with yields rising. Yesterday's data gave a bit of respite, which meant investors came in. And that's reflected across the capital structure. So lower cost of capital means better outturn for some equities, especially we see in Europe performing well. So that is helping where especially people have been underweight in Europe. And we think that's a bit of positioning coming through again.
And you want to follow the positioning in Europe in particular. I mean, where would that take you within the European equity space? Is luxury somewhere you want to have more exposure to now, for example?
Yes, I think luxury is an interesting sector in Europe. One, it's a global sector for Europe. It's one where Europe is particularly good at manufacturing those products. Also, it's very in tune with what's happening in China. So if we see some stabilization in China, I think that's going to help also. So what we've seen already with earnings this morning with the luxury names, we think the returns there could be quite substantial given where valuations have dropped so far over the last 12 months.
LVMH is up circa 8% right now.
Well, there you go.
That's a heavyweight stock moving an awful lot on one day. The CAC is now open. It's up by 1.5%. The problem that Europe faces at the moment is that it's hard to make an argument to buy it that is different to what we've had before. It's cheap, got a falling currency, but you talk to US investors and they still think that the home buyer story is probably the most relevant one that they need to pursue. You also talk to European investors, a lot of European investors, the first thing on the list is still buy America rather than buy Europe. What reverses all of this?
I think as we get through the new administration coming in, obviously next week in the United States, we'll see what trade policy looks like. And there's a lot baked in terms of investor expectations on tariffs and so on. So understanding a little bit more about what the administration wants to go after and how they build that tariff story will help investors really plan out what they think earnings are going to be in the rest of the world. So in the first half of the year, we think it's much more U.S. sector story, where the administration focused on domestic views of growing America. The second half is going to be us understanding what the rest of the world does in response to that. And there we see the second half story being a rest of the world story, where European and even Asian markets can.
So the rest of the world is going to outperform the US this year?
I think in the second half of the year we have much clarity that will help those low valuations in the rest of the world at least get a bit.
Outperform the US? Because that's the argument, isn't it? That's the argument here is, yeah, it's going to improve. Yeah, it's going to get a bid. There's a bid going to be coming. But is the bid going to be bigger than what we see?
If we think about what expectations are for the US today, they're much higher today than they were last year. So the room for positive surprise is much lower, where the room for positive surprise in Europe and
But that's
Asia
been true for a long time.
True.
So what changes this year to say, I want to put money outside of the US rather than inside the United States? Because all the portfolio managers are sitting there going, if I put money outside the US, I underperform.
Yeah, 100%. So we still think the US is the engine of growth of the world, right? How we think about other economies, for example, the politics, is that able to stabilize in Europe? Given what we see in France and Germany, we don't know yet. Is that a positive surprise coming? We don't know. If it is, I think that can be helpful. In the cessation of the war in Ukraine, that could help sentiment in the European sphere. And finally, whether China finally does the stimulus that is required can also help. So there are things that we want to look at to see whether the rest of the world can start to outperform the US. But the base case is the US is still the engine of growth for the world.
OK. Richemont, worth noting, up 15% right now. So all that spend from Guy Johnson on Van Cleef jewellery is coming to play. And you're seeing that reflected in the stock this morning. So the luxury boom is significant right now in terms of the upside. A 15% gain for Richemont. What about the currency effects for Europe? To what extent is that going to be a factor that plays positive for Europe on softer dollar? We get to parity, more cuts coming through, that central bank divergence of this year.
Yeah, exactly. So some of those earnings coming through in dollars are going to really help some of those European earnings coming through, that translation effect. So we will look at those global European names that will benefit from that. Equally, we will see some US names that have foreign earnings have to think about that strong dollar being a negative. So again, that is something that we have to think about when we build portfolios that have that cross-currency element to them.
Is dollar peaked at this point?
Well, it'll be interesting to see what the Treasury Secretary nominee says today. There's a lot of points that he's made in the past about what he wants to do with the dollar and how he thinks about funding the U.S. deficit. And I think that's going to mean a lot for investors today to get a bit of clarity around funding the deficit, how he plans to run the U.S. economy, and the fiscal spend that is required.
The 1-year chart, the 5-year chart of Richemont is extraordinary. So we're trading now at a 5-year high, just taking out the previous peaks. The volatility, you could argue today in this stock, is extraordinary. And we're starting to see this emerging in other stocks. We saw Novo Nordisk falling massively the other day, back end of last year. We've seen Eli Lilly doing the same thing on the GLP-1 story and what is happening there. You've got Richemont now rocketing higher. That stock is delivering some extraordinary numbers this morning. Single stock volatility. What should we expect in terms of volatility? Is that going to continue this year in some of these big names? And does that extend into the tech space as well?
I think it will. If we think about returns over the year, I think they're going to be much more narrow than the year previous. But the volatility...
So what do you mean by narrow?
As in, I think the dispersion won't be as wide.
Right.
In terms of what you get from bonds, what you get from credit, what you get from equities. I think the overall return spectrum will be much more narrow this year than was last year. And for that, we think that a diversified portfolio is going to work better because the Sharpe ratios in assets are probably going to be low this year. In that sense, investors will have to bear much more volatility for the returns that they receive. And we already see that this year. We see that in single stocks, and I think that's got to do with expectations. Maybe for those GLP-1 names, the expectations are very high. And any disappointment... NVIDIA expectations are incredibly high. So as we saw after CES, the stock did have a pause because there were expectations that are very high. And is the company able to achieve that on an ongoing basis? But this is throughout the market. We see bifurcation of expectations, very high in some areas, very low in others.
It's great to see you this morning. Thanks for stopping by to see us. Shaniel, Ramjee, co-head of multi-asset strategy, joining us from Pictet Asset Management. Let's turn our attention to what is happening with the Core 6. This is what the story looks like. Luxury is flying, folks. Take a look at what is happening with LVMH this morning. That heavyweight stock is up by over 8%, but it pales into comparison to the move that we are seeing over in Switzerland with Richemont, Joe.
Luxury, as you say, Guy, absolutely flying this morning. Some sensational moves on these stocks. We've got Richemont up around 16% at the moment. Remember, smashing some of its sales forecasts in terms of the latest period. Some of those numbers in double digits in the last period in terms of their quarterly updates. That stock on track for a record gain if this holds. It is actually the intraday biggest move for around 2 years on that stock. And feeding through into the broader sector, as you say, LVMH, that one was a massive standout, gaining around 8% at the open. There it is now, 8.2%. Now, bear in mind, Bank of America upgrading the stock as well just before the market opened, adding to the excitement, saying that they reckon there is the start of a luxury rebound coming into the market, and LVMH is their big way to play that, being the key powerhouse in that sector. And we're seeing the other firms swatch as well, with the Richemont watch read across, also Kering, Christian Dior. All of these luxury stocks are absolutely having a massive day. We haven't seen a day like that for luxury for some time. Then over in chips, we are seeing some gains in these stocks as well. TSMC, remember, over in Taiwan, gave a big update on their CapEx spending, around $42 billion they're going to spend on CapEx, and a lot of their suppliers are rising today. So ASML doing well, up 3.4%, ASMI as well, Soitec, all of those stocks gaining, potentially even a bit of feed-through coming through into luxury from other sectors today. Then another stock in clothing retailer, probably more my level. This is Zalando. It's kind of a bit of an ASOS over in Germany, but they've got a big update as well, a sales update, and that spurred an upgrade from UBS, saying that they like this company as a way to play the more lower end of the clothing market. So Zalando, one of the best performers in terms of retail today. A little bit of negativity. We need a bit of red on the screen. It can't all be green. We've got Wise coming down. The UK payment processing company missing on some of its volumes. Now, of course, this was a recent IPO a couple of years ago, and it hasn't had a great run. Down another 3% on that one today. Then in terms of rating changes, the one we flagged earlier, that was a sell at Goldman. That was for Nokia. Now, there is a lot of uncertainty around telecom infrastructure spending, and that's why Goldman cuts Nokia to sell. It's not so much the old phones with the snake game that we all used to play. It is about the infrastructure in terms of telecoms. That's a sell. AB Foods, finally. Primark, again, more in my region than luxury, but AB Foods, Primark. Now, this one, we're down 2%. This one is cut at City due to the rise in employer national insurance is the reason on that one. That's going to push their costs up. Luxury having a great day. AB Foods, Primark, not so much, but a big mover in London today.
Yeah, two different sides of the coin there. Joe Easton from our equity team, fantastic stuff. Thank you very much indeed. These moves keeping Joe and the team busy. Coming up, though, is luxury bouncing back in terms of, well, we can see it bouncing back today. Is that bounce back going to be sustained, though? Is the question longer term, is this a moment that will go down in your diaries as the pivot point for luxury? Richemont posting that surprise double-digit jump in sales. We'll have the details and the read across to the broader sector next. This is Bloomberg. Welcome back to the opening trading. We are 18 minutes into the Thursday session. Continues to be risk on for these equity markets, up 0.6% on the European benchmark. The luxury piece is certainly one of the catalysts. Stocks in focus this morning after Richemont reported a surprising double-digit jump in sales. its shares, as you can see, soaring more than 15% as things stand. Let's get the details on the earnings front then and bring in from Paris Bloomberg's luxury and retail reporter Angelina Rascouet. Angelina, talk us through the results. Investors cheering these numbers.
Absolutely, Tom. Investors are loving it. Richemont is up the most in more than 2 years after it reported sales in the last quarter that jumped more than 10% overall. But what was really impressive was the performance of what they call the jewelry maison. So that's Cartier, Van Cleef & Arpels, and they really that segment really beat estimates. They jumped by 14%. So that really tells you the strong appeal of these brands, the desirability that they have, despite, uncertain times. And even the watch segment did better than expected. I mean, it was still negative, but it did slightly better than expected. So overall, very strong performance.
Where is the strong performance coming from? Is it the United States? Are we seeing signs of stabilization in China? What's the picture?
Indeed. So the Americas were very strong. Europe as well was super strong, plus 19%. In Europe, generally, it's also led by tourism. In the U.S., what's interesting is that, early November, you had the U.S. elections. And typically what the brands have been telling us in the run-up to the elections is that consumers tend to hold back when it comes to spending ahead of the U.S. elections. But once that's out of the way, then they start to spend. And it coincides as well with a very important quarter, which is the holiday shopping season. China is still a drag. It was down 18%. But overall, Asia-Pacific was down, but not as much as expected. So, very strong set of results geographically.
The moves at the likes of Kering and LVMH suggest that investors are taking a cue and see this as a turnaround more broadly for the luxury space. Is that the right way to read it?
I think Richemont is in a particular category of its own because it really it's in the hard luxury business. So that's very strong jewelry brands that I was mentioning, the timelessness of these goods, and LVMH is more into the soft luxury segment. So they sell you more handbags. If you think about Louis Vuitton, and handbags typically they tend to be more seasonal. There's less that timelessness element about them. So we have to see when LVMH reports at the end of January. Hermès, it's typically one of the strongest brands, and generally they do well even when the market is retrenching. And Kering, we know that it's in turnaround mode. Gucci is really struggling. So again, I think it's you have to distinguish between the strong brands and the weaker brands which are in turnaround.
The moves this morning absolutely extraordinary, though. Richemont absolutely flying. Huge move. Take a look at the 5-year chart. Go on your Bloomberg and take a look at the 5-year chart. It's really worth looking at this morning. Angelina, thank you very much indeed. Angelina Rascouet walking us through what we are watching across the European luxury space. It's not just what we're watching with Richemont. It is being replicated elsewhere. LVMH, the heavyweight, rising massively this morning. Should we just talk a little bit about the chip stock? I want to talk about Rio in just a moment. Let's talk a little about chips. The read across from TSMC appears to be quite strong. Is it just the idea that actually the hardware story continues into 2025? Was there a risk that it wasn't going to kind of go into 2025? Because I noticed as well this morning on the TSMC story, they were focusing as well on the fact that CapEx actually doesn't look maybe as strong as some had anticipated. So what's the overall bottom picture?
It's investors consistently and constantly looking for that reassurance that the CapEx spend, that the spend and that the AI, where we are in this momentum around AI, is not waning. And you have reassurance coming through from executives that is the case, that demand is still there. C.C. Wei, who's the head of TSMC, saying he's more concerned about building out capacity than he is about that demand picture. And on the CapEx, look, the forecasts have been that they'd be spending around $35 billion US. That's now raised to potentially top end 42 billion. They've got the Arizona plant, they say, still on track. That's going to squeeze margins a little, but they just come through with margins of 59%. So you're seeing the read across to the likes of ASML. They supply into these foundries. ASML getting a lift in the Dutch session, up more than 3% right now. The lithography means they're going to have to buy. CC Wei's going to have to put in more purchases. Some of that 42 billion, not all of it, the fraction will go to ASML.
What I find extraordinary here is the gap between the US listed ADRs and what is happening in Taipei. Huge gap in terms of the spread between those two stocks, which maybe just represents the idea that everybody in America is very excited about AI, and elsewhere maybe a little bit more caution creeping in. You kind of want to go to the other end of the supply chain for our next stock story, and that is Rio Tinto. We're talking about copper here, of course, huge part of what we see in the AI story. Rio Tinto, the world's top iron ore exporter, has reported a fall in iron ore shipments amid continued lacklustre demand from China. But copper production is up. Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence, joining us around the table. What can I take away? What's the trend here? Is the iron ore story concerning? What do I read into copper? What does this mean for the sector? Kind of give us the top-down picture that we can take away from Rio.
Sure. So I think, look, just to say that the shipments were down, but I think they came within their guidance.
Yep.
So, yeah, it's nothing to be too concerned about. But certainly all the big diversified miners are trying to grow away from iron ore. That doesn't mean to say that they don't want to protect their iron ore businesses. These are great cash cows for the company. And the assets that many of the, like Rio has, are very, very cash generative and sit right at the bottom of the cost curve. So they want to protect those, and they are indeed investing in those. But any growth, they really want to skew towards copper. And in Rio's case, they made a sort of good acquisition at the bottom of the cycle in lithium. And they wanting to grow in what they call future-facing metals. So that's copper, lithium for the decarbonisation, electrification story.
Yep.
So that's part of the growth plan going forward. Then is to build out that part of the business. You talk about protecting the iron ore part of the package for them. Where does China? Is China turning around on this? Expectations about stimulus. Is the support coming through?
So in terms of, look, China's, if we take a longer-term view on China's steel demand, I mean, it is arguably in a secular decline. We've probably hit peak steel in China, and demand is probably going to ease lower. The debate in the market is how quickly does that happen? If we look back at Japan and the US, it's similar stages to their industrial cycle. You know, they dropped sort of 20% over a 10-year period. So it could be quite extreme. However, China, I think it was never a smooth path for those two economies. And I think in China it's going to be the same. So actually for next year and maybe 2026, I think China's, it has certainly indicated that they do want to apply a lot of stimulus. We've got perhaps fiscal stimulus, monetary easing. And I think that is going to be, in a long-term downward trend, give you a bit of a cyclical bump. So I think the outlook for China on steel and indeed the read across on iron ore is not quite as bearish as perhaps some in the market are anticipating.
Grant, thank you very much indeed. Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence, on the details coming through from Rio Tinto and the ties to China. Coming up, optimism from Renault as its key electric model helps boost sales. Finally, some positive news around the auto sector. We discuss the outlook for European autos next. This is Bloomberg. This is the Opening Trade. Welcome back. With 30 minutes into today's session, you are seeing risk on across the equity markets. Gains of 0.5% across the European benchmark. France performing very strongly indeed. The CAC going up 1.4%, lifted by what's happening in the luxury space. But we will focus now on autos, Guy, because you have some numbers coming through from Renault.
We've got the Renault numbers. We've got a broad... There's a little bit of good news coming through from Renault, but it's very hard to find good news when it comes to European auto stocks at the moment. As you can see, we are getting some outperformance there on the back of that. Feels like a very choppy trade this morning in terms of what we're getting. The headlines obviously are coming out of the luxury space, but it's nice to see maybe some good news being delivered for European autos. Horst Schneider, Head of European Automotive Research at Bank of America Global Research, joining us in London around the table this morning. Nice to see you.
Good morning.
How tough a year do European auto stocks face this year?
Well,
how much bad news is priced in? Is all the bad news priced in?
It's always the same, like as in the last 2 years. Performance in 24 was terrible. One of the worst performing sectors. Yep. It's cheap now. Beginning of the year, the people think, well, maybe everything is priced in now. Can only get up, and therefore the start to the year, in all fairness, it wasn't too bad, right, in terms of share prices.
So what happens to the rest of the year? Do I want to carry on with this trade?
Again, as in the last 2 years, then probably I think in Q1, Q2, we should be not too bad. And then people feel reminded about the challenges that we face on CO2, on trade. And then towards end of the year, we probably come off again. We have got lots of CMDs coming up this year. So we have got Mercedes, later on Porsche. Nearly every German company is hosting a CMD in H1. And as always, ahead of
Capital
the CMD...
Markets Day, just for those that don't...
Yeah, exactly, a Capital Markets Day. And as always, ahead of a Capital Markets Day, people believe, well, they tell us something, how it gets better, and therefore the sector lives from hope at the moment.
You think winter is coming to the German auto market? That doesn't fill me with a great deal of confidence.
Hasn't it come already?
Yeah,
I would say winter is there. I would agree to that. Winter is there, right?
So what happens? Do you get mergers? Do you get more factory shutdowns? VW's avoided some of that. They've come to some agreements with union and with Labour. Does Labour have to make more concessions? What gives to get the German auto sector back?
But the key problem for all car makers, not just for the Germans, is there is a killer model is missing. Like Tesla had that with the Model Y, BYD had a few strong models. The Chinese have got strong models. Then you have got the impression there's a long-term future. The problem is at the moment that nearly every EV model has flopped. So what the car makers need is convincing product. And here the hope is a little bit on 2026 when BMW launches a Neue Klasse, Mercedes launches 2 new platforms, which get closer to the techniques that also the Chinese are using. And that's the hope, that the product sells, right? And if the product doesn't sell, then of course you need restructuring. And next to the restructuring, then maybe you need government support. But that's something that the market does not really value, right?
But that's really interesting. You don't think this isn't necessarily an energy story. It's not necessarily a competition with China. Well, that's part of it. But the key thing comes down to actually producing a model that people actually want to buy. This is a design question for these.
Exactly.
So as an investor, do you sit out 2025 then until you get more details in 2026?
Think a little bit like that, because, I mean, you have got some product launches this year because we have tighter CO2 rules. Car makers need to sell more EVs, but it's not yet a convincing product. It's all about software in the vehicle. You need to use servers instead of microcontrollers in the car. You need to centralize the data streams in the vehicle. You need to have autonomous driving features. You get that more with the upcoming generations, and they come as of 2026.
You are close to these companies. Are they capable of delivering that kind of a technology? How fast is the ramp up? What's the rate of change here in terms of what you perceive is going on within these businesses?
I think they can manage it, but the problem is they're at the moment 4 or 5 years behind Tesla and the Chinese.
Does that gap
close?
They
also don't stand still. They keep running.
Yeah. So how do they close that gap? Do you need to make acquisitions? Is it about hiring software engineers? Is it about buying Rivian technology? How do you close that gap?
You name it. That's what they do. Rivian was from Volkswagen very important, but the problem is that the vehicles from this corporation, they come only in 27, 28, 29. It's a little bit late.
Yep.
BMW is maybe the earliest with the Neue Klasse, so that's 26, early 26. Mercedes is close to BMW, but I think the content that they use is a little bit expensive.
But when was the last time Tesla had a new model?
Well, they have got now the Model Y facelift. But the last new model was basically the Model Y, right?
Yeah.
The Cybertruck. The Cybertruck, I would not really count it as new model because it's not selling in volumes, right? So the last real volume model was the Model Y. They launch now the low-cost car this year. That's why I'm saying H2 could be a little bit more difficult in autos because Tesla launches maybe then the low-cost car, robotaxi in the US. BYD maybe is importing the BYD Seagull. Should be a below 20,000 euro EV in Europe, and that makes, of course, life for European car makers more difficult in Europe.
What is the market share that China takes, ultimately, from BYD, XPeng and others, from European market over a kind of 1 to 2 year period? What are you factoring in terms of the market share that they take?
Well, the problem for the Germans, for example, is in China, the Chinese maybe take everything there. The Germans can just survive on the ICE vehicle. In Europe, it's a different question. Depends also on tariffs, but of course, in the long run, they can take. I mean, long run means within the next 5 years, they may take 5 to 10% market share.
Does the perception of German luxury persist? There's been this kind of, you've got BMW, you've got Mercedes, you've got Porsche. Do these names have the same cachet in the new world that they had before? Because there must have, that was a huge benefit to them. Mm-hmm. And I'm wondering whether, I look at Porsche and I look at what is, you look at a 911, you look at a Taycan. It feels like a very different set of products and a different idea being represented by these kinds of vehicles. Does German luxury, we spent the morning talking about Hermès and LVMH and Richemont, that persists, but does German luxury in the car sector as an ideal, as a kind of truth that existed for generations, does that persist in this new era?
Well, I would say depends on the product. If you look at the combustion engine vehicles, there is the luxury. They have got great 6-cylinder, 8-cylinder vehicles. It's like with a mechanical watch. There's no mechanical Apple. But when we look about EVs, it's digital. Yeah, there's also no digital Rolex. And if you compare, for example, a Xiaomi SU7 to a Porsche Taycan, I don't know, 3-4 times the price, and the Xiaomi SU7 same specs, right? Accelerates fast, good digital interior. It's probably not the same quality, but of course the price is a lot lower.
But does a market exist? It's nice to have a mechanical watch. Are people going to? There's nobody telling me I can't have one of those on my wrist at the moment, but there are people in Brussels telling me that I can't have a mechanical car going forward. The regulation is very different.
That's a problem. That's why the valuations are low. It's ultimately about DCF, terminal value. How can they compete on these new products? So therefore, it's going to be a difficult journey for them, definitely. And that's reflected in valuation.
Winter is here. Horst, nice to see you.
Thank you.
Guy's animated. Guy Johnson is animated.
I find Porsche just seems emblematic to me of how you make that transition.
Successfully or not?
I think the jury's still out, and it's really interesting to see how. And I think the Rolex comparison is really useful in terms of people drove these cars for what they represented in terms of the mechanical engineering. People have these watches because what they represent in terms of the quality and the craftsmanship. You see it in Richemont this morning, but you're going into a different world. Is the Apple Watch maybe the nearest comparison? I don't know. Of course, great to see you. Thanks very much indeed. Horst Schneider, Head of European Automotive Research at Bank of America Global Research.
OK. We switch focus to another piece of engineering next, because Jeff Bezos' new flagship rocket, Blue Origin, lifted off for the first time and successfully reached orbit in a crucial test of the firm's ability to challenge another one of Musk's businesses, SpaceX. While the New Glenn rocket's upper stage successfully reached orbit, the booster portion was destroyed as it attempted to land on a barge or drone in the Atlantic Ocean. Let's watch in.
Autopilot enabled. T-minus 10, 9, 8, 7, 6, 5, 4, 1. Lift off.
OK, that was the launch of New Glenn, a Blue Origin, of course, about an hour and 20 minutes or so ago. Bloomberg Aerospace reporter Kate Duffy joins us for more. How significant was this launch for Jeff Bezos and for the team at Blue Origin?
I think truly significant. This is the first time that they've ever tried out this particular rocket, the New Glenn rocket, and it's been delayed several times because of the vehicle itself and also because of weather conditions, but finally it reached orbit, and that was their key objective during this launch, to reach orbit. They did experience a sort of malfunction failure with the booster, but that's something that can be worked on. This is the first time they're testing out the whole thing, whereas SpaceX tends to test it out in stages. So it's incredible for them, and they're really pleased.
I'm sure they are really pleased, but this thing was meant to be used 25 times. You need to get that bit right. Do we have any indication as to what went wrong, how significant a failure that was? Is it an easy fix? Is it a difficult fix? Do we have any details?
We don't have any details yet. They haven't released anything about what actually went wrong. We know that it just didn't land on this floating barge in the Atlantic at the moment. They're yet to recover the details. They've been collecting all the data, so that the next launch will hopefully see this data being used and proven, and they can sort of resolve what went wrong. So
if they can get it right, how big is the opportunity?
Huge. I mean, this will make sure that they can stand up against the likes of SpaceX and the Falcon 9 rocket. This means that the Blue Origin can take their business into the satellite division as well. They've already got their space tourism business on the go with the New Shepard rocket. And the New Glenn rocket opens up a host of opportunities for them. They have so many contracts. They have about $10 billion worth of contracts at the moment, whether it be with Amazon, Telesat or AST. They're also on the line for sort of NASA contracts and contracts with the US government as well. So this will open so many doors for them. It is a very lucrative business at the moment, the satellite. There's so many sort of different opportunities to get into. There's so much demand in the market now. So this will really open up the doors for them.
Talk to us about that. So it has more New Glenn has more payload, so it can carry more, essentially carry more stuff up into space versus SpaceX's Falcon 9. Does that give them an advantage, and how long can they sustain that advantage if they start commercial operations? Yeah,
it does give them an advantage. But obviously what we're seeing is Falcon 9 is so far ahead of the game. I mean, both companies started working on their rockets at similar times. Falcon 9 is reusable, it's reliable, it's the most frequent rocket that's commercially used. Is that
because they have better engineers? Is it because they are testing and willing to break things? How did you get a 10-year gap in terms of the innovation for two companies that start at the same time with similar resources?
It's hard to know, but Blue Origin takes more of a traditional approach where it just tests everything in one go, whereas SpaceX it comes across as being more competitive, more sort of, let's just try this out, and if it doesn't work, we're going to go back to the drawing board and just start again. And so what we've seen with them, with their Starship launch, which is hopefully coming up, is that they will test out these sort of dummy satellites that they're going to put into orbit with the Starship rocket, and hopefully they can use the chopsticks again to catch the reusable booster.
That's the technical term, isn't it?
Yes,
chopsticks.
of course, yeah.
It's incredible, though.
Yeah, it is amazing.
See it happen.
Visually amazing,
Yeah, and we didn't see it during the last launch.
No.
So hopefully, the launch that's going to happen in the next day or two, we will see that again.
Great stuff, Kate. Thanks for covering it for us. Bloomberg Aerospace reporter Kate Duffy joining us on what we have seen this morning from Blue Origin and the launch that has taken place there. We'll see another SpaceX launch a little bit later. We'll have some great coverage of that. I just want to break a bit of news that's coming through over the last few minutes. Benjamin Netanyahu's office is indicating that Hamas is creating a last-minute crisis that is halting the Gaza deal. The Israeli cabinet will now not convene to approve the deal until mediators notify Israel that Hamas has accepted all elements of the agreement. So an indication maybe that even phase one is proving difficult to land in terms of what we are seeing in Israel. Hamas, obviously the Qataris have been heavily involved in all of this. The US has been heavily involved in all this. But this is already proving difficult.
We have got so close so many times. We've never been closer than this. Phase one was meant to kick in, to your point, on Sunday. Is this a negotiating tactic to squeeze last-minute concessions out of Hamas by Israel? Is it something more fundamental? Is it a question of the cabinet? Is it a question of getting that support through parliament? We know the extreme right have been opposed to this.
That's not what the Israelis are saying. The Israelis are saying that it is waiting for Hamas to accept all the elements of the agreement. The implication there would seem to be that they're not pushing for anything extra. They just want Hamas to agree to what has been agreed. But as you say, it's not a deal until a deal is signed. And the deal has not been signed and approved, and we've yet to see it coming in. We're expecting this to happen on Sunday, aren't we? So does that deadline now get pushed out until the early part of next week?
Given that all hopes had been that you get this before the inauguration, of course, of incoming President Trump on the 20th. So we continue to monitor this story for you, evolving as we speak. We continue to keep across for you in terms of the details regarding that ceasefire that is looking a little more fragile right now. Coming up, European semiconductor stocks jumping after an upbeat forecast on AI spend from chipmaker TSMC. We dive into the numbers next. This is Bloomberg. Welcome back to the opening trade. We are 48 minutes into the Thursday session. We're seeing further gains across equities. European stocks are up 0.5%. Futures stateside pointing to gains of between 0.4 and 0.6. Over in France, the CAC 40 up 1.5%. Luxury is one of the key drivers on the back of Richemont earnings but technology as well as a sector also giving Europe a lift. On the tech stocks, you have BE Semiconductor, you have ASM International and ASML, all amongst the leading gainers right now. ASML, the maker of those lithography machines, up 3% so far in the session. That's tied to the earnings and numbers coming out of TSMC, which projected quarterly sales and CapEx ahead of analyst estimates, up to $42 billion of CapEx, fueling hopes that the spend on AI hardware will remain strong for this year. Let's get the details, the analysis with Stephen Tung, Senior Tech Analyst for Bloomberg Intelligence. Stephen, what is your making of the results and how they compare to market expectations? Because investors are cheering these results from TSMC. Does it support a stronger outlook for this business?
Yes, I think obviously the company reported a pretty strong set of results for Q4. Pretty much it will come in above expectation in all metrics, revenue margin, earnings, you name it. The demand for the 3 and the 5 nanometer technology has been strong, mainly for the application like high performance computing, which are mostly for AI and also for smartphone. So that's actually a pretty encouraging set of results.
If we take a look at the numbers, as you say, broadly encouraging, are there any areas that investors need to focus on and worry about? This is a company that obviously is right at the centre of the AI hardware trade. It is pivotal to so much that goes on in this space. Are there any cracks appearing?
I think on the positive side, apparently the AI demand still ongoing. The management highlight their confidence on the AI. And it appears that management worries more on the capacity than demand, because they are concerned that the capacity may not be enough to fulfill the demand, which is why they actually have a very strong CapEx guidance, which is, as mentioned earlier, is 38 to 42 billion US dollars versus last year's 29.8. So we're talking about over 30% growth in CapEx, and that's obviously a very strong number. And in terms of demand, the management continue to expect the AI chips to grow. They are looking at a more than double growth this year after triple growth last year. And then in terms of the revenue, they also expect the 5-year CAGR to be at least 20%. So all these metrics suggest the company's confidence, and obviously they are very confident on AI and also the ongoing upgrade in the process technology.
Steve, I'm going to leave it there. Stephen Tung, Senior Tech Analyst with Bloomberg Intelligence, joining us on what we're seeing in TSMC. I urge you, there's a great story on the Bloomberg talking about the gap that exists, the multiple gap that exists between the ADRs and what is listed in Taiwan, and just how big that gap is, and maybe just how that represents, you can see it there, how big maybe a gap that represents in terms of the outlook and the euphoria around AI. Let's talk about what we've got coming up for the rest of the day. Bank earnings continue. We'll come back to that story in just a moment. We've got Morgan Stanley earnings. We've got lots of things to talk about in that space, particularly following yesterday. Retail sales are going to be interesting, really interesting. The consumer remains at the heart of this story. How strong could potentially they be? What is happening with the inflationary impulse that's coming out? Maybe of the consumer. We'll learn more later. Claims are obviously going to be in focus as well. We've got the best sense confirmation hearing coming up too.
Yeah, he's expected to sail through this, given the Republican control of the Senate. He's seen as having quite widespread support. Whether or not he can thread that needle in terms of outlining a policy agenda for the Trump administration from the Treasury in terms of tariffs and tax cuts that are supportive of growth but not inflationary is going to be a question as well.
There's a really interesting Kevin Walsh op-ed in the Journal this morning. I was mentioning it earlier, talking about the idea that actually maybe the incoming administration isn't going to be as inflationary as the market is anticipating. Tariffs, yes, but on the other hand, he sees compensating factors on things like deregulation. Let's talk about what is going on with the banking space in the States. Big day yesterday, huge day yesterday. In some ways, almost eclipsed, though, by the CPI print that we saw coming out. But it's been a bumper earnings season thus far. Profits surging, 4 biggest banks already indicating we've seen some solid numbers. Equity traders at Goldman Sachs, particularly, having a very strong set of numbers. CEO David Solomon, though, calling for changes to the regulatory framework.
We believe it is our responsibility to continue to press for a more transparent regulatory process in order to foster a more efficient financial system that supports growth and competitiveness of the U.S. economy.
Kind of has to say that, doesn't it? Elsewhere, JP Morgan became the first bank in history to report more than $50 billion in annual profit. CEO Jamie Dimon was asked about his plans. The ongoing question, the perennial question, are you going to retire soon, Jamie?
I do love what I do. I'll be 69 in March. I think it's just a rational thing to do. I've had a couple of health problems, I just think it makes a lot of sense.
Let's talk about all of this. Charlie Wells joins us around the table to talk about what we've been going on. Let's start off with the personnel, actually, which is quite interesting. There are quite a lot of things changing, like at JP Morgan and elsewhere. Are we beginning to get the first changes in the guard that we've been anticipating at some of these big banks? Morgan Stanley, we've obviously seen that happen.
Yeah.
But elsewhere?
Yeah, Guy, I would say retirement is kind of in the air. I mean, clearly in the U.S. political sense, Biden is retiring. In the banking sense, there's a lot of questions. There have been promotions. There have been announcements about retirement. Paul Davies, in Bloomberg Opinion, has a really good piece out about this, and in it he talks about why these financial firms are keeping so mum about it, why they're being so secretive. Jamie Dimon was asked yesterday during that earnings call, point blank, who is your successor? Analysts wanted to know. And he basically said, we'll figure it out. We've got a deep bench. There may be some candidates that you know. There may be some candidates that you don't even know. Why the secrecy? I think the interesting thing here is that these banks, these financial firms, don't want to give investors, they don't want to give the media some kind of false narrative. They don't want to pin, the future on a particular person, have staff internally at the bank start treating them differently, give investors the wrong idea. So that's why there's so much of this kind of secrecy, but also so much of this retirement talk, because that is just in the air.
Given what we saw from the banks yesterday, can we fully expect that the earnings later today out of the big names are going to be as strong, as robust, and the outlook into the rest of this year?
It's looking pretty good. I mean, Bank of America is on tap, and, they're relatively asset-sensitive, kind of like JP Morgan. It's been a better story for net interest income for a lot of these banks, so we should see that there. It's going to be really interesting at Bank of America because they have such a huge consumer segment to see kind of how the American consumer is performing. We've also got Morgan Stanley. I mean, they're going to be really interesting in the wealth space because so much of their business has been sort of a pivot into wealth. So, analysts are really looking at kind of flows into wealth management there, but it's looking like a good news story for these banks, and I think that might be why people are so interested in personnel, because expectations are being met. What else can they wonder about?
Yeah, and can the next generation deliver? Charlie, great stuff. Thank you very much indeed, Charlie Wells, on what we're seeing out of US banks. That wraps things up. That was quite a morning. It's been quite a week in terms of what we've seen in terms of the news flow. Today we've had rockets, we've had Richemont, we've had what is going on in Gaza. The news flow is absolutely amazing at the moment, and the volatility in the market is almost in some ways matching that.
Yeah, for now, given those catalysts, if you strip out what's happening in Gaza, it seems to be upside and positivity for these equity markets, at least for now. European and US futures, I should say, pointing higher. The Pulse is next. This is Bloomberg.